I remember I told my dad once I bought a lottery ticket, and I wondered what my chances of winning would be. He said, if you bought 100 lottery tickets every day, do you know how long it would take you to have a 50% chance of winning? I thought about it for a second. I thought it was probably a lot, definitely more than a year, so I guessed 5 years. He laughed a little, and he said 18,000 years. But I still buy lottery tickets. Millions of people do. Are we blind to risk? This story isn't just about lottery tickets. It mirrors how Lehman Brothers, and indeed many of us, approach financial risks. Today, we explore how a giant was led to its knees, blinded by the promise of future gains without a clear view of the underlying risks. In part 2 of my 3-part series, we delve into Lehman Brothers' collapse, a textbook case of risk management gone wrong. We'll unpack how leverage and mortgage-backed securities became the catalyst for disaster. Exploring what leverage is and its inherent risk, we'll see exactly how it led to the largest bankruptcy in U.S. history. Did Lehman Brothers ignore the warning signs? We'll identify the red flags and the critical lessons every investor should learn from their downfall. Before we dive into the depths of leverage and its pitfalls, let's take a step back to where it all began: mortgage-backed securities. Understanding this link is crucial, but first, let's explore how these securities became the foundation of Lehman's ambitious strategies, setting the stage for a financial drama unlike any other.
The first type of mortgage-backed security is a pass-through security. We have different types of real estate, right? These can be individual houses or, maybe commercial real estate or any sort of real estate. There's mortgages on each of these real estate, so there's loans against that are collateralized by real estate in each case. These mortgages are pooled together in a mortgage pool. Then this is passed through to investors. So you pay your monthly payment on your mortgage, that mortgage goes to this mortgage pool, and that income is ultimately passed through investors. And it's all backed by mortgages, hence a mortgage-backed security. The other type of mortgage-backed security that we're also going to talk about is a collateralized mortgage obligation. This is more similar to what Lehman Brothers was using. Again, we have mortgages that are backed by real estate. These mortgages are pooled into a mortgage pool. However, this is where the differences occur. So this mortgage pool is then separated into different tranches, right? We have a AAA, AA, triple B, and double B. This corresponds to their risk profile and potential return. So AAA is going to be your lowest risk and your lowest potential return. This means when the money gets paid from the mortgages and into the mortgage pool, the AAA tranche is paid first. Investors that purchase the AAA tranche are most likely to get their money back. And after the AAA, the AA tranche is paid. Then the A tranche, then the triple B tranche, then the double B tranche. Double B is going to be your highest risk because it is paid last. However, that also means it's going to have the highest potential return or highest potential interest rate. Investors, depending on what sort of risk return profile, can choose different tranches. If they want a low risk, they'll pick the AAA tranche. If they want high risk, they'll choose the double B tranche. This will give the highest potential return. But again, if any of these mortgages defaults, the double B would be the first that would be unable to pay. Then it would go to triple B, then to A, then to double A. The AAA tranche is going to be the one most protected for investors, which again is why it offers the lowest potential return.
Lehman Brothers used mortgage-backed securities as a substantial portion of its business. In 2007, they are estimated to have purchased more than $100 billion in mortgage-backed securities and real estate assets. Now that we've unpacked the intricacies of mortgage-backed securities and seen how they were integral to Lehman's strategy, we're better positioned to dive deeper into how leverage, when combined with high-risk financial instruments like mortgage-backed securities, set the stage for one of the most dramatic downfalls in financial history. When I was a kid, one of my favorite activities was playing on a seesaw. Being able to lift someone else on the other side with little effort by placing your weight on it was intriguing and fun. A seesaw is a form of a lever. Just how you can use leverage to move weight on a seesaw, you can use leverage financially. Leverage allows individuals and corporations to amplify their buying power. Just like you amplified your lifting power on the seesaw, when you buy a house, for example, you typically don't pay the full price up front. Instead, you provide a down payment and borrow the rest. This is a form of leverage, turning a small amount of equity, your down payment, into the ability to control a much more valuable asset, the house. With a relatively small amount of cash, you can purchase a house worth much more than your initial contribution. Banks and financial institutions are willing to lend this money because they believe in your ability to pay it back over time, relying on your future earnings. This concept allows for significant growth and investment opportunities. Beyond control, leverage can also amplify returns. However, it also amplifies risks. See my previous video's explanation on how leverage works. In 2007, Lehman Brothers had embraced leverage to an extraordinary degree, purchasing over $100 billion in mortgage-backed securities and real estate assets. Their strategy hinged on the belief that the value of these assets would continue to rise, a belief that soon proved to be misguided. As we delve deeper, remember the seesaw. Just as leveraging your weight can lift someone high into the air, leveraging financial resources can elevate investments to new heights. But what happens when the weight on the other side suddenly disappears, or if you've miscalculated your own weight? The fall can be sudden and severe. Now let's explore how Lehman Brothers' extensive use of leverage became a precipitating factor in their historic collapse. Remember the lottery tickets? It's all about human psychology. We often see patterns where none exist and base our future expectations on past events. This tendency leads many to believe that if markets have gone up in the past, it will continue to do so indefinitely. This psychological trap is not just for the inexperienced. It ensnared even the seasoned expert at Lehman Brothers, people who were seen as the smartest in the industry. The 1920s stock market, the dot-com bubble, and the real estate market of the early 2000s. History has a way of repeating itself. Investment banks, Lehman Brothers included, were making enormous short-term profits by trading highly risky loans. They were not just dabbling in subprime lending, it became their primary business model. Lehman Brothers turned from an investment bank into a glorified real estate hedge fund, focused almost exclusively on the riskiest part of the market, subprime loans. Before we dive deeper into the psychology of risk and its impact on decision-making at Lehman Brothers, let's pause for a moment to understand a crucial concept, the leverage ratio. This measure tells us how much a company relies on borrowed money to fund its operations and investments. But more importantly, it indicates how vulnerable a company might be if market values start to decline.
So I looked up Apple Investor Relations. You can do this with any company, by the way. We'll go to SEC filings. We'll go to annual filings, and here's the 10K for Apple in 2023. So let's click on the PDF. So this is what we want. So let's use our total assets here, and this is in millions, by the way. It's our total assets. Now for our total equity value, right, so a leverage ratio of 5.7. So right now, there's zero change in market value. Let's say the total value of the asset goes up 5%. So our new equity value, right, originally it was $62,146, is now $79,775. So only a 5% increase in market value led to a 28% increase in our equity value, right? But this also occurs in the negative direction. So let's change this to -5. So the total value of our assets has gone down by 5%, right? This means that the value of our equity has gone down by 28%, right? Let's say it goes down 10%, a significant market downturn, -56%, right? So 5.7 is deemed as maybe a little bit high for a company like Apple, but is within reason considering the amount of assets that they have. So let's do Goldman Sachs for 2023, right? So this brings us to the first page. So what I like to do is go to the consolidated balance sheet. We have our total assets. So we'll put this in for total assets. Then let's find our total shareholders' equity. So we'll copy this. Now you can see Goldman's 2023 leverage ratio is at 14. This is a lot higher than Apple's, but this is considered somewhat standard for an investment bank. If the total value of Goldman's assets increased by 5%, their equity value would increase by 70%. Let's do this for 10%. Let's say it goes up 10%, 140%. Now if it decreased by 5%, they would go down by 70%. And then if they decreased to 7%, their equity value would nearly wiped out. And at 8%, their value goes negative, so there's no more equity left, just by assets going down by 8%. Now, again, it's not expected for Goldman's total assets to decrease this much because they're so diversified, but it just goes to show how leverage can severely impact the value of equity. If the market goes up, it can go up a lot. If it goes down, it could go down a lot. Let's look at the leverage effects on Lehman Brothers in 2007 based off their financial statements. So because Lehman Brothers no longer exists, we have to go to the SEC website for this. We're going to go to Filings, Company Filing Search. We're going to look up Lehman Brothers. Search for Lehman Brothers. And we just want annual and quarterly reports, etc. So here we have the 10K in 2008 for Lehman Brothers. So let's click on it. Open the filing. This is Lehman's 10K in 2007. And we'll scroll down to their financial statements. Okay, here we have their, in 2007, their total assets, total stockholders' equity, leads to a leverage ratio of 30.7. It's actually listed here. We could double check here. Leverage ratio 30.7. So you can see from 2003 to 2007, their leverage ratio increased from 23 times to 30 times. So Lehman Brothers, let's say the total value of their assets increased by 5%. That means that their equity increased by 150%, 10 times 300%. But look at this. Just a 5% decrease in the total assets leads to a complete equity wipeout. This is why it was so dangerous to have such a high leverage ratio. Yeah, if the market keeps going up 5%, keeps going up 2% every year, it's very reasonable. They can expect 60% returns on their equity year over year. But just decreasing 4% in the total value of its assets, their equity is completely wiped out. This is how risky Lehman was. Let's look at Lehman's real estate exposure. So mortgage and asset-backed securities of its owned assets are $89,000, by far the biggest line item. And real estate is also a substantial line item too. So real estate is nearly a third of what their assets are. Lehman has a tremendous amount of exposure to real estate and to real estate related securities. This is why a change in the real estate market of just a couple percent led to the ultimate downfall of the firm. Just by going through this 10K, we can see the signs of Lehman's exposure to the real estate market and how much was on the line given their high leverage ratio.
This wasn't just aggressive, it was a massive gamble, predicated on the belief that the real estate market would only continue to rise. But markets are fickle, and reliance on past trends without considering the fundamentals is a dangerous game. Subprime loans are just that, subprime. It's one thing to have this as a section of revenues, but another to have it as the core center of the business. As we've seen, Lehman Brothers' strategy was not just about leveraging assets, it was about betting the company on a continuous market upswing, a bet that would soon come to haunt them as the real estate bubble burst, leaving them and the world economy reeling from the fallout. Could investors see this happen? Were there warning signs? Absolutely. Anyone that looked around and saw home prices going up could have seen it. I understand that hindsight is 20/20, but you have to think about the fundamentals. You have to go into the drivers of the housing market. What is the value of real estate in this country versus growth in GDP? The housing market was inflated above GDP growth, but nothing materially changed in the housing market other than the price. Let's look again at Lehman's business. They were making huge amounts of profits based on the real estate business. But what are they making money on? They are making money on highly risky loan products. It's one thing to invest in subprime, it's another to have that as your entire business strategy as an investment bank. Lehman became a real estate hedge fund on subprime loans. Not just real estate, but on the absolute worst loans in real estate. It's a failure of common sense. It's a failure of long-term thinking. Loans made to people that have no income requirements, no job requirements, and no assets do not make sense. The warning signs were there: the disproportionate growth in real estate prices, the reliance on risky loan products, and the substantial deviation from market fundamentals. The truth is, there were those in Lehman itself that were ringing the alarm bells. People like Lawrence McDonald, a former vice president at Lehman and author of A Colossal Failure of Common Sense. a detailed account of Lehman's internal dynamics leading up to its collapse. McDonald and other like-minded colleagues sounded the alarm on the bank's overextended leverage and its unsustainable bet on the real estate market. Upper management prioritized the short-term profits of real estate over long-term business fundamentals. Lehman Brothers' downfall serves as a stark reminder. Understanding the market fundamentals and maintaining a cautious skepticism can be your best defense against getting caught in the next bubble. The collapse of Lehman Brothers wasn't just a tale of financial mismanagement. It was a warning to all investors about the dangers of ignoring market fundamentals and the importance of prudent risk assessment. But the story doesn't end here. The fall of Lehman Brothers set off a chain reaction, reshaping the financial landscape and leaving investors with vital lessons on navigating uncertain markets. Are we better equipped today to spot the warning signs and safeguard our investments against similar catastrophes? Join me in the last video of this series, where we'll explore the aftermath of Lehman Brothers' collapse, examine the regulatory responses, and dive into how individual investors can apply these hard-learned lessons to make better decisions in today's financial world. Thanks for watching. See you next time.